Are you a practice owner like I was that would, at the end of the year, would get my profit loss statement from the accountant, quickly look at the bottom and look for brackets, which means I lost money and not know what to do about it? Are you the type of person that wonders what your profitability is? Are you looking at selling your practice? And if you are, you need to know what your profitability is. If you've got any of those things going on, this episode is for you. Watch on. Hey everybody, Dr. Joel Parker here with the Standing Ovation Practice. Thanks for tuning in. Listen, I spent 17 years in private practice, most of those in an ownership position, and the last 20 years consulting private practice owners and managers just like you that are watching. What I found is that there are some absolute do's and don'ts. I'm going to give you guys what to do here. And today's topic is talking about diagnosis and repair up tune-up series, specifically what profit loss statements are all about. Now, in my practice, I was looking kind of just intrinsically, the way we think as clinicians. We always think about what's the data, what's the assessment, what's the plan, right? So I would get to the end of the year and I would get these profit loss statements and my balance sheet from my accountant. And often than not, I'm a pretty quick study like you guys. You look to see if there's brackets down below, that means it's a loss. Or when color printers came in, that would turn red. But I wouldn't really understand. I would go, just holy shit, I've had another loss year, another poor performing year. And so what I later on discovered is that profit loss statements, sure, they're good for the year-end filing, but start using them monthly and start tracking your profitability. If you can track it, you can change it, you can improve it. So don't wait to the end of the year to track your profitability, start tracking it monthly. And the monthly one reflects all of your actions that you've taken on that weekly management frame of time. If you remember, there's the year-long season of veterinary medicine, the 12 games, that's a month, and then there's 4 weeks per month. Those are your weekly management chunks, right? Your intervals. So profit and loss statements, what are they? All these are showing you is how much revenue came in, what you spent your money on, what your tax accountant did for write-offs in terms of writing off the interest on your loans, any taxes you paid, any depreciation on equipment, and any amortization on goodwill. Like those are all accounting tax write-offs. So at the end of the year, that shows you what your profit is. But for management purposes, we want to look at these on a monthly basis right here. So there's our yearly one for tax filings, but we want to do the monthly so we can start to manage by. Like, let's say that you start tracking your monthly profitability, you work it out, and let's say it's 12% one month and it crashes down to 6% the next. That means you've got time to jump all over and get onto it. Don't wait to the end of the year. So what's a profit loss statement look like on a monthly basis? Coming out of QuickBooks, you can get your bookkeeper accountants, who's ever doing this for you. If you're doing it yourself, then I like that. Then you can go ahead and print it off as an Excel file. And what we're going to look at here, initially right at the top is your revenue. That's the amount of money that you collected. Below that are your expenses. And what I like you to follow here are 5 expense categories, not 50, but 5, because you're taking kind of a 40,000-foot view of your practice on a monthly basis. The first one here is your cost of goods sold. That's the cost of your medical supplies. It's your merchant fees, your rabies tags fees, things like that. Next one's your HR, and that's your human resources of both DVM and non-DVM. Here's your facility, which is your rent, your lease, could be your mortgage, it could be your utilities, things like that. Here's office, which is insurance, flowers, paper, pens, and down here is PR and marketing. And there are some ideal percentages. Your COGS should be less than 22%. Your HR should be less than 44%. Your facility less than 8%, up to 8%. Office 4%, and then marketing PR about 2% in a mature practice. And what that does, everybody, is that leaves you 20% leftover money at the bottom. Okay, so these are really industry standards that I've seen work out over the years. There are some variances. Sometimes you're going to pay a bit more rent. Sometimes your cost of goods sold may be a little higher, et cetera, et cetera. But the bottom line is, there's numerous ways to spay the cat. We just don't worry too much about this stuff up here, other than you want it to be no more than 80%, leaving that 20% profit. So that's what we're looking at. By the way, this method is also called EBITDA. This is the earnings, also called profit earnings. It's that leftover money before the accountant deducts the interest off of your bank loans, before you pay any taxes, it deducts the depreciation of your tangible assets. That's your equipment, your building, your renovation, and also deducting amortization. That's the goodwill. If you bought a practice like I did, bought a combination of tangible assets that depreciate and intangible assets. That's the goodwill, the reputation that you amortize. So at the end, when I did tax filings, I would see in my practice for a certain number of years, both write-offs of depreciation and amortization. If you started your practice, you're not going to have any amortization. You're not going to have any goodwill to write off. You didn't have any when you started, right? But you're going to have equipment to depreciate. Okay, so two words that kind of mean the same, that you can depreciate. You can write that equipment off, a certain percentage of it every year to lower this profit so you don't pay taxes on it. But on the monthly basis, we want to be tracking this. Okay, everybody, that's profit. Profit is good. The ideal is over 20. I've had practices go 23, 24 that are skilled managers. Practice owners, just like yourselves, that stood up, kind of had that look in the mirror with themselves, that talk with themselves in the mirror saying, listen, I'm going to be not a good practice owner, I'm going to be a great practice owner. And guys, you know, what I also found too is that the management of my practice, what I found is that there was increasing use of specialized services around my practice. So a lot of the really interesting surgeries and procedures I was referring out, leaving me to do a little bit of the general, I don't know, vaccine kind of, style veterinary medicine. And for me, it wasn't just enough. I eventually got into endoscopy, and I eventually got into really managing my practice, using the profit loss statements and really tightening things up. Okay, I hope you've enjoyed this content here today. If you'd like it, please hit that like button, that little thumb down below. Please subscribe. Please turn on your notifications, tell your friends, and please leave me a comment down below, and I'll see you at the next episode. Thanks for watching.